Hi, welcome to Trading with TK, teaching you to turn ideas into money. We're at www.tradingwithtk.com, and this is our weekend question and answer where I try to answer some questions that have been sent in to me by some of my readers. So let's get started. This question comes in from Craig. A question for your weekend question and answer. Paulson bails out AIG with $85 billion and an 80% stake in the company, and then bans short selling on the equity. Do insider trading rules apply to the government? It's a great question. I'm not a Wall Street lawyer, but as Craig suggests, maybe we should pass this question on to Martha Stewart and see what her take on this is. This is great insight, Craig. I can't answer the question, but I had to bring it up. Okay, next question comes from Tom. Tom says, if you get a chance this weekend, can you explain overhead supply? Sure. Okay. Overhead supply in a stock technically is basically a resistance area. And how it's formed is, let's take stock ABC. ABC rallies from 4 to 8, and then for the next month it trades between, let's say, approximately $7 and $8. So it's back and forth for a month. A lot of buying and selling going on, probably distribution, some sort of consolidation when the stock goes sideways for that long. Okay, a month later the stock rolls over and breaks 7 and trades back down to 5. All the people that bought this stock up there at 7 and 8 are saying to themselves, boy, if this stock would only rally back up to 7 or 8 again and get me even, I'm going to get out. 2 months later, the stock turns around, rallies back up to the 7-8 area, and all those people that bought it 2 or 3 months earlier now want out because it's back to them getting even. And that's what creates these supply areas. It's this overhead supply. It's all the people who bought it, who made a mistake, and now that they're getting back to being almost even, they want out. And that's what a resistance area is. Now the same thing is true on the downside for support areas. Stock trades 4.5 for 2 months and then breaks out and goes to 8. Okay, all those people who bought it at 4.5 have a nice profit. So the next time it comes back down to the 4.5 area, they remember, oh, the last time it was down here, I bought it and it almost doubled our money. So let's buy it again. So that's basically how supply and resistance areas get formed. Call it overhead supply if you want, but it's basically a resistance area. I think that should answer the question. It's not all that complicated. Okay, this question comes in from Jean. This question is for your weekend question and answer. How does the overall market behavior, indexes or charts, affect which stocks you trade? For example, if the market looks highly bullish, do you trade 80/20% to the long and vice versa if it looks bearish? All right, well, I'm a sort of a freelance type of trader. I don't go by any specific formulas or rules because I've learned over the years that they may work 2 or 3 times and then you rely on them and then they blow up in your face and they annihilate you. So no set formula actually works. But I'm much more comfortable if we have a decent, uptrend that's going to last for a long time. I'm much more comfortable going with the current. In other words, if we've got a nice long uptrend, I like to play the long side because that's the way the river is flowing. Okay, but it's not going to. It doesn't say that if I see an opportunity where a stock has gotten way ahead of itself, even though we're in a big bull market, that I think there's an opportunity to make 30 or 40% on the short side. As long as I see the opportunity there, I may take it. But normally speaking, if the market's going up, I'd like to be long all my positions, because there's always that doubt as to why am I short this thing when the market is rising, especially if it's just something that hasn't been really overbought. Like I said, I'm more of an opportunist in the marketplace, freelance thinking sort of, than to stick to any kind of formulas. But I always really feel more comfortable going with the flow of the trend. Okay. Okay, I had a question from Mike. It's kind of long, but basically I'm going to condense it in my own words, because it's a good question, and it's a question that I have thought about myself a couple of times. Mike wants to know, with all the turmoil that's going on, and there is turmoil, and it sounds really bad, why is the Dow holding up as well as it is, in light of the fact that we almost sound like we have a meltdown going on? And if you want to relate it to a low, the low of the 9/11 attacks was around 7,500 in the Dow. So this sounds worse than that. Why are we holding up at these levels? So this is a great question, and it's a question I've thought about for quite a while. I don't know the real reason, but I'm going to give you my take on it. Okay? This crisis that we're in right now, really the credit markets have taken the brunt of this. The credit markets are the markets that actually crashed. The equity market, which is the stock market, is holding up fairly well in light of the news. Okay? But I'll say this, that if this credit problem is not solved somehow or another, that eventually they will turn to the stock market for funds. It always happens. For instance, if you're a regular Joe, okay, and you've been saving in your IRAs and your 401ks, but all of a sudden you're on the brink of disaster and it's going to take your house away and you've lost your job, okay, all of a sudden retirement is the last thing on your mind. What's on your mind is survival. So what almost sounds unthinkable at times about selling your retirement account, when you're forced to, you will, to survive. So if this credit problem is not solved and this economy slips deeper and deeper, eventually they will get around to knocking the stock market down, because there'll be no other source of funds for people to raise, and they'll be selling their IRAs and they'll be selling their 401ks. It sounds like a scary scenario, but I believe that the credit markets have crashed already. Okay, the stock market's holding up because they're not the recipient of it yet. But if it gets worse, I kind of think that maybe the market will slip again. I know we're talking about little bullish formations here and there, but I'm not pounding the table that the market has definitely made any kind of turn here at all yet. So we're watching it, but we're not out of the woods yet. Okay, so anyway, I hope that answers all your questions. I have fun doing this. If you guys have any other questions that you think the trading community would all be interested in, send them on in. I'll see if I can do a little research and answer your questions for you. Until Monday, and I hope there's a deal, this is TK signing off.